We are joined from Dubai by Arun Leslie John, joining us from Century Financial, Chief Market Analyst. The US market opening, do you think it will be impacted a lot, a big decline, or do you think the risks and declines are still limited compared with the equity markets in the region?
I think the decline in US markets will be limited for the time being. Obviously, right now what we are seeing is a increase in the uncertainty. There is a rise in the tensions. So the market is certainly facing a lot of uncertainty, uh, but for now the decline should be limited unless and until the war escalates significantly from here. So why the decline will be limited, or the impact will be limited for the US market? The US economic data has tended to be steady. I will not say strong, but it has tended to be steady. The earnings from the companies, they are also been in line with expectations. So, apart from that, from the macro perspective, last week we saw the CPI come in line with expectation. It came in at 2.4 percentage, so which is better than the situation a few months back. Even the core PPI, the producer price index, that also came in near 2.8 percentage, much better than the 3 percentage plus numbers we had a few months ago. So the overall numbers on the economic side seem to be steady or improving for the United States. So the impact should be limited as of now until and unless a drastic escalation of the conflict take place and impacts the oil prices.
Aaron, since you are saying that any impact will be limited, when we look at the picture, if we put the geopolitics aside, there are no signals of a move from the Fed soon. The earning season is over. What will bring S&P 500 back to the record levels or the levels seen in February? Because despite the resolution with China, it's not back to those levels.
The more important fact is that the index SPS 500 is still trading near the highs. In spite of uncertainty, it has not given up that much of a gain. Now, what can take it forward? Uh, a softening of the inflation or change in the Federal Reserve language can be potential triggers. But then another supporting factor for the index again can come from the administration itself. If they are deciding to go for corporate tax cut, even though it might impact the bond market, there is a possibility that the stock market might take it positively, especially the small cap index, or more deregulation of the markets. So there are triggers there. The triggers are more related to the administrative policy measures as of now.
Okay, Aaron, oil prices rising swiftly and by big amount, especially the rally could continue after the market opening. How will this impact equities in the this week?
If oil prices rise swiftly from here, and if there's a dramatic, I think the West Texas Intermediate, the WTI, which is the US benchmark, is trading near $73 level. If there's a sudden jump, maybe a $10 or $15 jump in those numbers, it could be having an impact on the global markets. So emerging markets, especially China and India, which are big consumers of the Persian Gulf crude oil, will could see their stock markets impacted. Even the US could be impacted because a sharp rise in oil prices mean the inflation, which is coming lower or which was kind of getting softened, will again rise. And if inflation rises, that could be impacting the bond markets and that could even force the Fed to delay its rate cut plans. I mean, a rise in oil price means the Fed will be holding back for sure. Certainly not a positive scenario for the international markets, but I would like to guess that the emerging markets will be impacted more than the developed markets.
Okay, Aaron, we saw dollar move, which was trading at the lowest level in 3 years, but with the rise in the tension and struggle between Iran and Israel, there was a rise in the dollar. Does this mean there is a confidence back to the US as a safe haven?
The US dollar has, you are right, the US dollar has gained in response to the tensions in the Middle East. I mean, in the short term, there might be a gain in the US dollar when compared to the other currencies, but I don't think it's going to be a long term trend actually. I mean, the major reason being that the macro factors are beginning to support the euro due to a rise in the stimulus programs launched by the European governments. European interest rates are likely to stay steady, or the European bond yields are likely to stay strong. So, what we are witnessing here is that on the long term, the European governments are increasing their spending. Increasing their spending leads to rise in deficit, and a rise in deficit leads to European bond yields. So the yield disparity with United States will be coming down, or the the US yields will not be that much higher than the European yields in the long term. So the long term picture means that the dollar will not be staying that strong. The dollar index, I'm not bullish on the dollar index in the medium term, but short term, yes. I mean, the tensions can lead to a safe haven demand for the dollar.
Arun Leslie John, Chief Market Analyst at Essentially Financial. Thank you so much for having joined us today. Have a
Thank
nice
you.
day.
Sure.